And it's time for business. We're starting in Europe, in fact, today, and we're expecting some more bad news today, aren't we, Will?
Yeah, I'm afraid so. After Wednesday's anti-austerity protests across the continent, we're expected to see the Eurozone as a whole drop back into recession, a double dip as it's become known. The figures are coming out later today from Eurostat across the continent. Ones to keep an eye on in particular is Germany. Of course, until now they've been the driver of Eurozone growth, but they're expected to see their GDP fall again, the growth at least to just 0.2%. Now, in the last few minutes, France has published its growth figures for the third quarter, and actually it has managed to avoid recession, 0.2% growth. Not a staggering figure there, but better than it could have been. And also the figures for Q2 have been revised up from just stagnant to 0.1% growth. Now, you can see why that's such good news for France, because Greece down 7.2% for the third quarter, and Portugal down 3.4%. So that is the sort of difficulties that some of the countries in the Eurozone are facing.
OK, well, let's move across the waters to the US now. President Obama drawing up his battle lines when it comes to tackling the fiscal cliff. That, of course, is the series of automatic spending cuts and tax rises coming into effect this January, unless compromise can be reached between Obama's Democrats and the Republicans.
The American Congress has less than 7 weeks to find an agreement on government spending levels that's eluded them for the past 2 years. If they fail, automatic budget cuts and tax increases will come into effect in the new year. Barack Obama says he's confident that they'll find a compromise.
I believe this is solvable. I think that fair-minded people can come to an agreement that does not cause the economy to go back into recession.
In the meantime, Obama wants to agree an extension to the tax cuts already in place for all but the wealthiest 2% of Americans to mitigate the impact of the fiscal cliff.
We should not hold the middle class hostage while we debate tax cuts for the wealthy.
On the 31st of December, a raft of temporary tax cuts are due to expire just as huge automatic spending cuts are introduced, hitting individuals and businesses simultaneously. It's Federal Reserve Chairman Ben Bernanke who coined the term fiscal cliff to describe the combined effect of these measures, totaling $600 billion. The savings could help reduce the country's national debt, but the Congressional Budget Office is worried that they could also drive the economy back into recession.
OK, how's all that affecting the markets then, Will?
Well, as you can imagine, with all that uncertainty, the US markets are down, were down in the last session of trading, and also, of course, the events in Israel and the Gaza Strip have helped push oil upwards. Meanwhile, in Asia, similar lack of positive sentiment across most of the markets, except in Japan, where, of course, that snap election was called when the markets were closed on Wednesday. They're hoping that that will bring a spring in a step to the economy.
OK, it's looking good there on the Nikkei, but Sony has bucked that upwards trend in Japan.
Yeah, their shares have dropped by around 10% in morning trading in Japan. This comes as the company borrows around $2 billion. It's borrowing on the bond markets. And what's made the shares drop is that essentially those bonds are going to be convertible into shares when they're paid back. So instead of having their money back, the investors can have it back in shares instead. Now, if you're an existing shareholder and you see these extra people, the investors, getting thousands of extra shares, potentially, then you think, well, my share's worth quite a bit less. So it's for that reason that the cost of the value of the shares has dropped so much in this session.
And as Sony struggles, an up-and-coming technology company is making waves.
Did you say up-and-coming?
Because that's up-and-coming. And
yes,
up-and-coming, but up-and-coming may work.
Is quite, yeah, I think that kind of works. One of the famous apps for iPhone, for Google, Android devices, etc., is Spotify, a music streaming service which works by accessing music in the cloud. You can pay extra to avoid adverts for it, and the company's doing rather well. In fact, they've just raised $100 million in new investment. That values the company as a whole at $3 billion. Now, it's not all plain sailing, however. Of course, the company is still making a loss at the moment. But Spotify also faces competition from similar competitors such as Deezer. But also the big giants of the tech industry are looking to get more and more involved in music, such as Microsoft and Google. And Apple's iTunes is rumoured to be considering a streaming service to be announced in the coming months.
Adverts? Didn't you mean appverts?
No, it doesn't work for them all, I'm afraid.
Now, next, Cape Town's AfricaCom Technology Conference is currently underway, and research shows the number of mobile subscriptions on the continent will reach 761 million this year. Let's take a look at the world's fastest-growing cell phone market.
Africa is the fastest-growing mobile market in the world. The number of subscriptions on the continent is set to hit the 1 billion mark in 2015.
There is an insatiable appetite because there are no fixed-line alternatives. So it's not a matter of people wanting to have a mobile broadband connection to complement their fixed broadband connection or a mobile connection to complement their home phone. In this case, it is basic communication is only available over mobile. There is no fixed-line infrastructure.
According to London-based Informa Telecoms and Media, the African market should grow 18% by the end of 2013, while the world average is 11%.
Now there's a big push for what we call price-competitive handsets coming into the continent. And this has been a trend over the last couple of years. The so-called $100 smartphone. Well, guess what? It's here. There are now $50, $70 smartphones coming in from countries like China and India that are doing really well in the African continent.
There is still room for expansion in Africa. The continent is the world's second largest mobile market behind Asia, but penetration by the end of September was only 68%, while the world average is 91%.
Finally, I'm sorry about this, more puns on France 24. It's going from bad to worse, isn't it? Will's written this. It could be that a storm could be brewing in the tea industry.
Clever, eh?
Very.
Right. Well, what it is that Starbucks says it wants to do the same for tea as it has already done for coffee. By that, it doesn't mean that it wants to serve tea in gallon cups and make it very milky. What it means is that it's buying a company called Teavana, and it wants to expand it internationally. Already, this company has around 300 stores in the United States. They sell loose-leaf tea and sort of high-end exotic teas. They're trying to keep it a premium brand. And Starbucks already does have a tea of its own, but it's looking to separate these into a different brand, different stores with tea shops inside them, and spread that idea across the globe. The chief financial officer of Starbucks has said it's the second most consumed beverage in the world, second only to water. So that's what they're going after, basically.
OK, Will, thank you very much. Will with the business. Just before we go, we're going to take you back to show you some live images from Gaza today. Apparently a rocket's just been fired. My producer telling me in my ear there from those images they could see that rocket being fired out of Gaza. Of course, comes as violence continues today. The confrontations between the Israelis and the Palestinians entering a second day there. We've also been hearing of the Israeli military apparently dropping leaflets on people, warning them to stay away from Hamas. But those are the latest images coming out of Gaza. We'll leave you with them here on France 24. The very latest news coming up with Claire after the break. Stay with us if you can.